Hey traders, welcome to the YouTube channel. So thank you for joining me. Today we're going to be going over an idiot-proof trading strategy that anyone can use. And it's actually one of the mechanical systems I originally used. It's evolved a bit now. And I'll talk a little bit about that in the video as well. Before we start, if you can just like, subscribe, hit the notification bells, all that good stuff. So yeah, let's get started. So beginners, do you feel overwhelmed? Too many gurus telling you what to do, too much info, often conflicting advice, and you're just suffering from analysis by paralysis. You know, this is so common. It's easy. There are two main types of trading. There's mechanical trading, so this is predefined, rule-based rules that can actually be automated. And it involves low emotional involvement, recommended for beginners. And then there's discretionary trading, and this is based on human judgment. Emotions can majorly influence decisions for experienced traders who are comfortable with risk. So with discretionary trading, it takes experience to trade like this. So this is why I was advised to start mechanical, and then as you evolve and grow and you gain a bit of experience, you can start adding discretionary element, which is what I've done. But instead of making it discretionary, I've made it rule-based and systematic. It's like almost mechanical. And that's all because I started with a mechanical system, you know, so I created the right habits. So why I start with a mechanical strategy? So it's best for beginners to start. It can help reduce human mistake. So you can start creating the right habit. You don't have to worry about timing, prevent regret after a trade, you know, with the rules being black and white. There's no error on your part. If the strategy didn't work, it's the strategy's fault. It will help build confidence, discipline, and a foundation in market understanding. A stepping stone before you dive into divergent trading later in your trading career. So I started with this strategy and now I'm trading full time. I'm the co-founder of the Divergent Trader. I have over 300,000 followers collectively online. And I'm also the author of the book, The Blueprint to Trading Psychology. As well as all that, I've traded full time for just over 5 years now. Got about 10 years of experience. So I've lived this and I know what I'm doing. So you're in safe hands. So today I'm going to cover the mechanical strategy that I used together when I started trading. But first, let's just go over some indicators that are useful for creating a mechanical strategy. So EMAs are really, really good and objective. Bollinger Bands and RSI. So these are two that we'll be using today. And you can use candlestick formations as well. So EMAs give more weight to recent price data compared to older data. So there's different EMAs, there's a slow moving average, which will be called an SMA. With like an EMA, it's more responsive to the current market conditions. So you can use an EMA to identify trends. So if the price is above an EMA, that indicates you're in an uptrend. And if the price is below an EMA, it indicates it's in a downtrend. So it can be very useful for creating a mechanical strategy, a trend system. So Bollinger Bands, it's a popular technical analysis tool used by traders to measure volatility and identify potential price trends and reversals. And it's made up of 3 bands, a middle, an upper, and a lower. And apparently if it hits the upper band and comes out of it, there's a good chance it's going to reverse. And if it goes outside of the lower band, it's a good chance it's going to reverse again. And you can also use that as a trend signal. So I don't want to over confuse you with this. And it uses standard deviations. So it's set to 2 standard deviations. So when it's 2 standard deviations away from the mean, the EMA, it tends to revert back to it. So I like to use a wider setting on this, so it's even more stretched than the EMA, which we'll cover in a minute. RSI, this is another good one that I like to use. So it helps to determine overbought and oversold conditions and identify potential reversals. For example, if it's over the 70, generally indicates an overbought. If it's below the 30, that usually means it's oversold. How I like to use the RSI is to look for a divergence, specifically classic divergence here. This one. So that's that's maybe an arrow. Don't know why I drew it like that. Price makes lower lows, for example, on price, but on the indicator, the RSI, it'll be making higher highs. So price is making lows, on the indicator, it's making highs. So here's an example. You can see price is making a high there, and it is on the RSI, but the second peak here is making a high, and on the price, it's making a low, and that's what we call divergence. And here we have a long example. So we have price making a low, a lower high, a lower low, but on the indicator, it's made a low, a lower high there, doing the opposite. So price will show the opposite on the RSI. That's basically what it is. If price makes a lower low on the RSI, it will show as a higher low. If price makes a higher high on the RSI, it will show as a lower high. Just doing the opposite in a nutshell. So here is a breakdown of the strategy. So with the RSI, I like to set it to 75 and 25. This just makes it a bit more overextended. And with the Bollinger Bands, I like to set that to a 2.5 standard deviation. So with the first peak, you wait for it to go RSI oversold like it does here. Once we get that, you wait for it to pull back and then make a new high. We want to see it reject the Bollinger Band. We want to see a wick come outside of it, and you can see it does here. And it also closes higher than the first peak, and it has to close higher back via the body. So this is where the body close, that's where the body close on the second peak. Once we get that, we look for divergent, and you can see price is making higher highs on the indicator, making lower lows. Once you get that, you enter with an ATR based stop loss, and then set your targets. A 1-to-1 works really well, and you can just set and forget and walk away. Now, why I like the set and forget approach is because it takes you out of it. Half of the battle is managing yourself, and if you take yourself out of the environment, especially the trade management side of things, which a lot of traders struggle with, you know, you're removing a lot of the emotions. So a set and forget, a 1R, let it go. And also with a shorter targets, you're allowing yourself to get a higher win rate. You'll get more wins, and that all creates confidence. Again, that's good for the psychology. So that's why it's good. You're going to stay confident. It's going to give you a good psychology. So here's how you do the ATR stop loss. So if you hover over the candle that rejects the Bollinger Band and then bring up your ATR, and if you can see at the bottom left here, it says 59. So if you're using, for example, a 2 ATR stop loss, you times that by 2, which is 118, and then you enter at market, put your stop loss 11.8 pips above, and that is your ATR stop loss. So the ATR is mechanical. It's not, you know, you're not having to think where to put it. You're just basing it on the ATR, and that's it. You go. And the ATR is based on the volatility of that market, so it gives you a true idea of how much it could move. So this can avoid you from getting wicked out, basically. Gives it a bit of wiggle room. So here's a trade example. So we look for that RSI to go oversold, which it does here. Then we want it to pull back and then close lower via a body. And you can see it does close lower, like so here. And then we look for a rejection of that Bollinger Band, and you can see a wick comes out of it there. Next, do we have divergence? Yes, we do. Price is making lows on price, but on the other side, it's going up. Once you get that, enter 2 ATR and set it to 1R, set and forget. And this one did pretty well. So a mechanical trade management that you can use if you do want to actively manage it, a great mechanical one is a time stop. So with reversals, they should work pretty much straight away. So this is where a time stop works well. So here's how you do it. You wait 4 candles and then you move it to break even. Or if it's not in profit by 4 candles, you exit the trade, and that's it. So the benefits of using this is it saves you capital, so you get small losses. It will save you mental capital, so you don't have to see the drawdown and lose the trade. 3, it saves capital for the next opportunity, so you're not holding all your capital in one trade while it's just messing around. You know, you can move it to the next one that works straight away. So that is a great technique that you can use if you do want a bit of extra control over the trade. Something I like to use is high value areas. So these can be things like imbalance, support and resistance. And one of them is liquidity. So adding liquidity for areas of value to trade off is a beautiful thing. It really does increase the probability of this mechanical MW to work. What you do is you wait for price to come to these levels and then look for the MW to set up. And when it does, you know, it really does increase the odds. So here we have a liquidity example. So as you can see on the left here, we have a liquidity area right here. What you do is you draw a line out, and then you simply wait for price to come into that level and create that MW setup. So let's go to the next slide, and you can see the purple line where price has now gone into it and took out that liquidity. So then you look for that MW. Is there an MW set up? So what you can do is you can see the liquidity on the daily time frame at daily level, and then zoom down to a lower time frame. Maybe it's the 1 hour, the 15, whatever you want to trade. Look for that MW. So the RSI goes oversold here on the first peak, pulls back, closes lower, rejects the Bollinger Band outside of the Bollinger Band with a wick, and creates that divergent. And then you set the 2 ATR, set and forget, and off you go. This is just liquidity. As you evolve, you can start adding more confluences and whole numbers, candlestick confirmation patterns, lower time frame confirmations. You know, you can add this and make it your own, which is what I've done as well. So what to do next? I do have a PDF of this in the description, totally free, where you can learn a bit more in detail. Also, I've got a free Discord channel that you can join and watch me trade this strategy live. Obviously, like I said, it's evolved a bit more. There's a few more things that I do with it, but you can learn that for free in the Discord channel as well. Again, I'll put the link in the description. So yeah, that's what you can do. Now that you know what trading strategy to master first, next start exploring your trading edge. So watch this video next.